Hare Krishna. Welcome to my channel, Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing. And today we are trying to explore the chapter number 17. What would Benjamin Graham have taught about indexing? So, Mr. Warren Buffett already confirmed about this thing, what Mr. Graham endorsed for the index fund. So, let's just see what Mr. Graham has to say about the indexing. So, as per Warren Buffett, The Intelligent Investor, which is written by Benjamin Graham, is one of the best books on investing ever written. So, we clearly see that one of the great investor is appraising another great investor's book, The Intelligent Investor. And the book title itself says that if you want to really become an intelligent investor, then you should be intelligent enough to read this book and understand that book. So today we are trying to see what when Bogle is reading this intelligent investor, how he is trying to interpret and how he is trying to get the data that index investing is going to be better for a real investor. Let's just deep dive into that. So this intelligent investor was book was published in 1949. That's really a long back, and I think it was almost after 26 or 27 years after that. That was the first time when the index investing was introduced. So, this Intelligent Investor is regarded as one of the best book of its kinds because of the comprehensive analytical perspective and forthright. So, this book is for the ages. So, it's this is a kind of a wisdom which is going to continue. It's not limited to a particular time. So, Benjamin Graham is known for his focus on the kind of value investing, and at the same time, he also cautioned that the aggressive investor must have a considerable knowledge of security values or the stocks and armed with mental weapons that distinguish him from the trading public. So I think two things are really required. If you want to really be trades in the stocks, then you should be he's classifying them as aggressive investor, and you should be having good knowledge about your stock. At the same time, you should be mentally very strong and trying to avoid you from converting an investor into a trader. So that's something really important. So the Bogle clearly says that from this reasoning, we can conclude that the majority of security owners would elect the defensive classification. So definitely, if you are not an aggressive investor, then definitely you are qualified for a defensive investor. And what that defensive investor need to do, that is what we're trying to understand in this chapter. So now the question comes is that why defensive portfolio is recommended for the most investor. So Graham here is saying that the majority of investors do not have the time or the determination or the mental equipments to embark upon such investing journey. So that we really have to understand that we need, if you really are a stock trader or a stock investor, you definitely need the time, the determination, the mental equipments. So all those things not everybody has. We have to really limits that what are the conditions where we can perform good and what are the conditions where we are not. We have to understand our circle of competence. Then uh, Graham further says that they should therefore be satisfied with a reasonable good return obtainable from a defensive portfolio, and they should stoutly resist the recurrent temptation to increase this return by deviating into other path. So you can clearly see that with the last statement, he's trying to give a hint of some kind of a defensive portfolio, which Bogle is trying to conclude that he's talking about S&P 500, and we should really resist of trying to beat the market if we are uh, not an aggressive investor who has all this time determination and the metal equipments. So, the defensive investor, the Graham's advice is that for the defensive investor who really required assistance, Graham originally recommended professional investment advisor who rely on the normal investment experience for their result and who make no claim to being brilliant, but pride themselves on being careful, conservative, and competent. Those chief values, whose chief values to their client is to shielding them from costly mistake. That's something very important. So as per Benjamin Graham, what is a good professional investor? A good professional investor is not claiming that he is a brilliant person. He is not going to tell you that which stock or which mutual fund is going to beat the market. In fact, he will be always a careful, a conservative, and a competent one. That means a good professional investor advisor is going to recommend you the index fund. And if he is not doing, then definitely he is not a good professional investment advisor. And a good professional advisor, the last thing which he's adding is that he is making people to make the costly mistakes. So he is managing their emotional aspects or their behavioral aspects also. That's also a very important job of an investment professional advisor. If you are not able to manage your behavior, then definitely you need an investment advisor. Then Graham further cautions us that the investor should not expect too much from the stock exchange houses. That's also very important. That he clearly says that all these AUM industry that we are seeing, we cannot expect a huge wealth creation for us from all of them because they are in a business. So then Benjamin Graham further continuing and says that the Wall Street is in business to make commissions, and that's a way to succeed in business is to give customer what they want. Trying hard to make money in a field where they are condemned almost by mathematical laws to lose. So look at this. So we have to understand that if the AUM industries are going to give us what we really want, then do we think that they are going to make commissions or good money out of that thing? They cannot make thing, because if they are really going to advise us that okay, invest in a low cost index fund, then how are they going to make these good commissions or the great expense ratios which they are charging, or some of these active mutual funds? They cannot make it. So definitely it's a mathematical law. So if one is going to perform good, other is going to suffer. So if a AUM company is going to make good commission, then their customers are going to suffer. And if some AUM company is looking for the welfare of the customers, then that AUM company itself is struggling. So that's something we have to understand. Then Benjamin Graham further says that a stock market resemble a huge laundry in which institutions take in large block of each other's washing without rhyme or reasons. So he is comparing the stock market just like a huge laundry, where one mutual fund is going to dump all his investment into other is going to buy, then the other mutual fund is going to dump, then there is some other mutual fund is going to buy. So you see, so one mutual fund is looking value into one thing, but then other mutual fund is seeing that it's an overhyped price. So look, so all these mutual funds are having different perspective. So that means they are having no good reasons or rhyme that why they are buying this large block of clothes. Bogle continued to add on this one. It says that a mutual fund makes no claim of to superiority over the market averages. So that's really important because we understand from the previous chapters learning that it's not the mutual fund or your mutual fund manager who are going to earn the return from for us in the market. So market returns are going to be derived by the earning growth and the dividend yields of all the companies that are going to make for our nation. Then Bogle continues and says that the Graham commented to use the investor of leading investment fund as an alternative to create their own portfolios. So later in the book, Benjamin Graham further says that investor can also use this. Investor can also use these leading investment funds as an alternative for creating their own portfolios. But at the same time, Benjamin Graham also well described or well established the mutual fund, where he's saying that they should be competently managed, making fewer mistakes than the typical small investor, and carrying a reasonable expense and performing a sound function of acquiring by holding and adequately diversifying list of common stocks. So you read the last statement very carefully. He clearly defining how what a mutual fund or an investment fund should be. Competitively managed, making fewer mistakes, carrying a reasonable expense ratio, and performing sound functions by acquiring and holding. So if you look at all these statements, which of the active mutual fund is going to classify with this? That should be a question as a retail investor we should be asking. If I look at this reading, it clearly says that he is talking about an index fund, because index fund is the only one which is going to fulfill all the criteria which Benjamin Graham has listed. And that's the way to use by most of the investor. That's what Graham is recommending. Then Grimes further conclude that where he says that the at a later of his age, where he says that the figures are not very impressive in either direction on the whole. The managerial ability of investment fund had just about able to absorb the expense burden and the drag of uninvested cash. So Graham also agreed that mutual fund can have some ability, but that ability is being observed by two components. What are those? The expense ratio and the uninvested cash. We all know that every mutual fund house need to put uh, some portion of amount in their cash in hand just to fulfill any kind of redemption request, and then expense ratio is another thing. So these two things are definitely is observing all the abilities of the mutual fund owners. So why we want to go for then actual mutual funds? So Grams, if you really want to take the lessons from Graham's conclusion, is that always avoid the active mutual funds and go for a low cost index fund. Graham further says that the unsoundly managed funds can produce spectacular but largely illusionary profit for a while, followed by inevitably by calamitous losses. So you can see that here Benjamin Graham is also putting up the principle of reversion to mean. So there can be some fund which has performed really good over the past couple of years, but then all of them are going to come with a huge losses also in the following year. So reversion to mean principle, which John Bogle talks about in one of his chapters, and in fact many chapters, the same thing is being Benjamin Graham is also talking about the same thing, and just the wordings are changing, but the basic principle remains the same, which is reversion to mean. Graham further says that the real money in investment will have to be made as most of it has been made in the past, not out of buying and selling, but of owning and holding securities, receiving interest and dividends, and benefiting from their long term increase in values. So, Benjamin Graham also is in favor of long term investing, where you buy and hold. John Bogle is also saying that you buy the index fund and hold it forever. You see how the wordings are in sync with of all these great investors. But we retail investors are not listening to them. We always think that we are the one who are going to beat the market. But unfortunately, it's the market which is going to beat all of us. So if we don't want to avoid that beating from the market, then we should be listening to these great advice and listening to the wisdom of these great investors. So Bogle is trying to conclude and saying that the whatever Benjamin Graham told in 1949, it is making uh, making an impetus for him to start these 1976 his index fund. So you see the 26 years of data, and he is taking three major points which Benjamin Graham has listed in his book. First of all, Benjamin Graham talks about owning and holding a diversified list of securities. So if you talk about the diversified list of security, then index fund is definitely the one which is having the most diversification, covering the most number of sectors for a given nation. The second point is that strictly adhere to the standard conservative and even unimaginative form of investment. Benjamin Graham, for a defensive investor, always talks about conservative things. So index investing is the way to go. And then the last option, he's saying that the he advises the defensive investor to emphasize diversification more than individual selection. So once again, diversification, conservative, all these words are clearly indicating that the index fund is a way to go. So that's why Bogle conclude that even Benjamin Graham is also in favor of index investing, although he written his book in 1949, almost 26, 27 years before the first index fund was launched. So later in his life of Benjamin Graham, where he talks about the failure of the investment manager. So in one of the interviewer asked him that can an average manager obtain better result than S&P 500 over the years? And the Graham's answer is no. And then he explained, in fact, if that is not the case, then that would mean that the stock market expert as a whole could beat themselves, which is a logical contradiction. So you see nowadays all the markets are perfect. We have all the required knowledges, all the mutual funds houses have all the required information for all the stocks. Do you think that they can beat the market? No. If we say yes, then that means we are saying that the one stock expert is beating the another stock expert. So if one mutual fund is the winner, there is another mutual fund who is going to be the loser. So if one large cap is the winner, there is another large cap which is going to be the loser. Same thing with the small cap. If one small cap is going to be the winner, there will be another small cap which is going to be the loser. Unfortunately, it's the retail investor which is going to be loser who is not listening to the great advices and investing in a S&P based index fund or let's say Nifty 50 or Nifty 500. Bogle also adds to this and says that there is no evidence that professional experts earn higher return than individual amateurs, nor there any kind of institutional investor, the pension managers, the mutual fund managers earn higher return than any other class. So you look at this. So he also look all the past data and his experience clearly says that none of these professional experts, the pension managers, the mutual fund managers are beating the market. So why to go for them? Why to pay the higher expense ratio and have a cost impact on our investment journey? Why not stick to a low cost index fund? There is another interview where one of the interviewer asked Benjamin Graham that whether investors should be content with earning the market returns, and the Graham's answer is yes. You should be satisfied with whatever market returns are being given to you. So if you are investing in a low cost index fund, then you are earning a fair share of your fair share of a market return, and that's the way to go. And you should be content with that. That's the way to make huge wealth, or that's the way to do the this investment journey. Then further, Benjamin Grimes add that the all investor want good result from their investment and are entitled to them to the extent that they are actually obtainable. He further says that I see no reason why they should be contained with result inferior to those of an index fund and pay the standard fees for such inferior returns. So later in his life, he is also in advocating with the index fund. And he clearly says that there is no point in investing of these active mutual funds, which are not going to beat the market. And we are paying some additional fees for that. So we are getting poor returns even after paying the additional fees. So that doesn't make sense. There is no logical reason to take this kind of an steps. So stick to a low cost index fund. So Benjamin Graham is intimately connected, indeed almost synonyms with value investing and the search of undervalued securities. So we really understand that Graham is always about value investing. This book is all about value investing, and that's what Warren Buffett also does. But his classic book is given far more attention to the down to earth basic of portfolio policy, the straightforward, uncomplicated principle of diversification, and the rational long term expectation. So you look how a normal retail investor is going to read Benjamin Graham and how the John Bogle is reading the book. There is a huge difference. Apart from value investing, the Graham has talked about all these important things about the portfolio, diversification, the long-term investment expectation. All these things will be missing if a great person is not reading that thing. That's why it's really important that we should always associate it with these great people. I know that not every retail investor can do that thing, but reading their books is one of the best way, and that's something I feel that every retail investor can do, and that is what we are trying to do in our channel, so that all of us can associate with these great personalities and trying to extract the wisdom out of them. Benjamin Graham is further adding and says that I am no longer an advocate of elaborate techniques of security analysis in order to find superior value return. So you look at this, even at the end of his life, after all his experience, whatever he has seen, he says that it was a rewarding activity, says 40 years ago, but the situation has changed a great deal since then. So that is something we have to really understand. When we are reading these books, we have to understand that at what point of time that book was written. What was the scenario at that point of time? Does the same scenario exist now? If not, then how can you expect that whatever that book is trying to convey, the same principles are going to apply here? So even the Benjamin Graham says that the now this kind of value investing is not going to work. But we have so many value-based index funds or index fund, not only active mutual fund. In fact, the value-based indexes are also being launched. Do we think that they are going to beat the market? Unfortunately, no, because things have really changed now. So, in the light of enormous amount of research now being carried on, I doubt whether in most cases such extensive effort will generate significantly superior selection to justify their cost. So now we see that everybody is doing research. Now we have AI intelligences. Now we people are doing a data mining in with such a great extent. Do we think with this kind of an efficiency, even there are algo tradings, computers are being used for doing stock investing. Do you think that with this kind of an active research, an active manager can beat the market? They can beat the market, but all the costs which they are going to take, that is going to observe all their beating, and in fact they will end up lower return than the market, and they will end up not able to beat the indexes. Then Benjamin Graham, in his final advice, he says that fortunately for typical investor, it is by no mean necessary for his success he bring the time honored qualities of courage, knowledge, judgment, and experience to bear upon his program, provided he limits his ambition to his capacity and confine his activity within the safe and narrow path of standard defensive investment. So Benjamin Graham is again talks about circle of competence. We really have to understand that our courage, knowledge, judgment, and experience are pretty less. Our common retail investor does not have those kind of a details qualities. If you have, definitely feel free to do that thing. But if you don't have these things, then please stick to a low cost index fund. Please stick to a defensive investment portfolio, which is investing in a low cost index fund. Then Benjamin Graham further says that the to achieve satisfactory investment result is easier than most people realize, and to achieve superior result is harder than it look. So that's something we have to understand actually. We can earn some good return with a very easy way, which is index investing, but our mind doesn't take it. Our mind really think that there should be some kind of a complex logic I have to do, then only I can earn some good return. But that's not true. That's what Graham is advising. At the same time, when we try to think that we can beat the market, this thought is looks very beautiful, but in practical, it is not. It is much harder than it looks. So that is what we should be taking, and I think that's how Benjamin Graham is really concluding that we should be indexing, we should be investing in a low cost index fund. And Bogle also concludes it saying that with Benjamin Graham's long perspective, common sense, hard realism, and wise intellect, there is no doubt whatever in my mind that he would have applauded the index fund. So look at all these statements which Benjamin Graham has put up, and Bogle is clearly saying that Benjamin Graham, is also in favor of index fund, and we have to agree with that. Indeed, you will read in Warren Buffett words that follows that precisely what he did. So not only the Benjamin Graham, who was a teacher of Warren Buffett, Benjamin Graham is advocating index fund. Warren Buffett is saying thing. John Bogle is saying thing. But we retail investors are thinking, no, 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 beat the market. So look at this thing. What we are doing, we are making a huge mistake in our investment journey by not listening to these all these great investors. Then at the very end of his life, The Benjamin Grimes says that the ideal way to dollar cost average is into a portfolio of index fund which owns every stock or bond worth investing. So for both stocks as well as for bond, the Benjamin Graham is clearly advising to index in an invest fund, especially if you are doing a SIP kind of an activity. If so, SIP is for dollar cost averaging. So that kind of dollar cost SIPs are going to be most beneficial if you are doing it for an index fund, not for an actively managed mutual fund. So that is something we have to take from this Benjamin Graham's quote. He further says that that way you renounce not only the guessing game of where the market is going, but which sector of the market and which particular stock or bond within them will do the best. So, see what are the benefits of indexing investing in index fund. You are completely away from this guessing game that where the market is going. If you look at the retail investor, most of them are starve as soon as they wake up. They try to guess where the market is going to be. Is it going up? Is it going down? And that is their anxiety for the whole day. So they're beginning their day with that anxiety. They're ending their day with the anxiety. And the Benjamin Grimes says that if you are doing a SIP in an index fund, then you're completely away from this thing. Then why you want to make your investment journey with so much of anxiety? If you're investing in a good diversified index fund, you don't care which sectors of the market is going to perform good. You don't care about that thing. So see, second level of anxiety is also being removed. The third level of anxiety is that which stock is going to perform good. If you have 10, 20 stocks in your portfolio, if one of them goes up and down, you really have 20 type of worries because you have 20 more the stocks you are holding in your bonds, more you are worried. Correct? Because on a daily basis you start tracking them. And same thing happen with bonds also. But if you really invest in an index fund, you can remove all these three kind of anxiety at all three different levels. Don't you think that's the way to do the investment journey or passive investment? We all are saying that we are doing passive investment, we want to generate passive income, but then we are actually doing an active work on that because it's affecting us on a day-to-day basis. That's not the way to do passive investing. So index fund is a way to do passive investing. That's what Benjamin Graham is concluding after all his vast experience. And to continue with Benjamin Graham's learning, what Warren Buffett has to say, let's just read. A low cost index fund is the most sensible equity investment for the great majority of investors. My mentor, Benjamin Graham, took this position many years ago, and everything I have seen since convinced me of this truth. So, you look at the life journey of Benjamin Graham and all his knowledge, he is recommending index fund. And then Warren Buffett, who is learning all this knowledge from Benjamin Graham at his early age, and he is also having such a long journey of 60, 70 years of his investment. And he is saying that whatever I have learned from Benjamin Graham and whatever he has seen in his life, he really convinced with that truth. And what is that truth? That invest in a low cost index fund that is going to help the great majority of investors. So if you want to really become those among those great majority investor, then please stick to a low cost index fund. Just knowing that okay, investing in low cost index fund is good is not sufficient. You really have to understand the logic behind all that thing. And these great books like Latest Back of Common Sense Investing are going to put those knowledge seeds among you so that you will be really convinced. So tomorrow, if anybody comes and say their index funds are not good or go for this fund or that fund, then you will have good amount of arguments to say or to come or to defend yourself. If you're not taking those knowledge, then definitely anybody can shake your faith and you will become your loser. And again, you will move from active to passive, passive to active. So these kind of jumps you will keep on doing, and at the end you are not even able to beat the returns of the FD, and you are going to die poor, unfortunately. So if you really want to avoid that thing, then please stick to a low cost index fund. So I hope by now you are pretty clear what are the learnings from Benjamin Graham Intelligent Investor book, what is his experiences, what is Warren Buffett trying to conclude, and how John Bogle has extracted the same kind of a knowledge which both these great investors says. So if you want to really listen to all these three great investors, then listen to them and invest in an index fund, a low cost, well diversified index fund. So thank you everyone for staying with me for such a long time. So I hope you get something out of this thing, and I hope you get some glimpse of intelligent investor in the Little Book of Common Sense Investing, and I think both of them are going to add some huge value in our index investing. So if you think that this kind of contents are really helping you out, then please, please, please feel free to like, share, and subscribe these kind of contents to more and more retail investors. Let them get educated. Let them become wise, full, intelligent investor. That is the aim of this channel. So please, all of you can help me out to do that thing. That would be a great service that we can do to all retail investors. I will again come up with a next chapter very soon. Till then, thank you once again. Hare Krishna.